Hi guys, Milad Rezai here. In today's video, we're going to talk about salary sacrificing into your super. You probably have family or friends, colleagues at work that have told you on certain occasions they are salary sacrificing into their super fund and how great it is. And you're probably thinking, what are they talking about? So what we're going to do today is give you a rundown of what it's all about, give you some pros and cons, and more importantly, what to watch out for. And the last point that we're going to reveal today in this video is absolutely critical to get right. So stick around, put your feet up, and let's get into it. So what is salary sacrificing into superannuation? It's where you have an agreement with your employer where a portion of your income before any tax is calculated or paid is contributed towards your super fund. So what you're doing is you're having a conversation with your employer going, hang on a minute, that $3,000, that $4,000, a portion of your income, I don't want anything to do with it. I don't want you to pay it into my, pay it to me as a salary. Why? Because my marginal tax rate is, 32%, or it could be as high as 45%, not including Medicare levy in Australia. I don't want to pay all this tax on my salary. So take a portion of my income. I don't want to see it. Pay it into my super. Pay it into an environment where the tax on concessional contributions, which is before tax contributions, is only 15%, very low. And thereby, what you're doing, you're achieving two things. A, you're lowering your tax bill outside of super, your assessable income. So as an example, if your salary is $60,000, and you've gone and salary sacrificed $4,000. So you told your employer that $4,000, I don't want to see it, send it to my super. You're only going to be assessed on $56,000. So you pay your marginal tax rate on $56,000. And point B of the benefits is the fact that you put another $4,000 into super. It's going to grow because your super fund is invested. Every dollar that hits your super fund is going to be invested. If you haven't fiddled around with your super fund and put it all into investing in cash, it's going to be invested. So in the long run, it's going to be working for you and getting your return. So the overall picture of salary sacrificing is to be in a position where you are increasing your superannuation over the long run and you're paying less tax outside of super. So what are some of the pros of doing some salary sacrificing? Well, number one, you're getting more money into super. When money enters super, what you're exposing yourself to is the power of compound interest and time. What's that all about? So $1 in super is not just sitting there, it's invested. And over the long run, it's very powerful because you are benefiting from investing principles like compound interest and time. And the idea, we have another video that talks about that, but it's all about having interest on interest on interest paid to you. And over the long run, your super fund will be in a much better position. What's another benefit? So lowering your tax bill outside of super. So if $3,000, $4,000, $5,000 or $10,000 is salary sacrificed, that is taken off your assessable income for the financial year. Therefore, the tax that you pay outside of super is going to be less. Now, another benefit of that is the fact that if the money's not sitting outside of super, it's much less likely that you spend it on variable expenses that most Australians, and we can all put our hands up and say we're guilty of this, we tend to just spend. When it's in super, it's gone, it's not accessible, and it's working there for your future. So what are some of the cons? And you might just be thinking, well, you just said this is a good thing, but if you don't have access to this, you actually are in a position where you have to potentially wait till age 60 to hit preservation age where you can get access to your super. So putting money into your super fund means that it's gone for a very long time for most people and you don't have access to it. So for a younger person, if you're thinking of building your wealth and you want to put money into super, that's great, but don't forget that superannuation is an environment where there's no access. So you'll have to wait till preservation age. Now, there are special circumstances like special release circumstances, however, very tough. I mean, we had some cases with COVID, but I mean, what are the chances of those kind of circumstances coming up every few years? Pretty slim. Another thing to consider is if you are a very low income earner, and I'm talking low income earner, so in a tax bracket of 19%, it's questionable whether it's worth your while, the tax savings. So have a chat with a financial advisor. Or if you are earning above $250,000, your pre-tax contributions are generally taxed at 30%, not 15%. So that is very important to note. The last point, and the most important when it comes to salary sacrificing, is understanding the caps. What is the before tax concessional contributions cap in Australia? And not only just when you're salary sacrificing the first year, but for as long as you are salary sacrificing, you need to be all over this. Right now, it's $27,500. That's the cap. So when you salary sacrifice, the first thing you need to do is go, well, what's already being used up in my cap? And your SG, super guarantee contributions that your employer is putting in, that forms part of your cap. So if your salary is $100,000, right now the SG rate is 10%. So say $10,000 is going to towards your super. So you only have $17,500 left before the cap basically runs out. So you can only salary sacrifice $17,500. You don't want to go salary sacrificing $27,500, not considering the fact that your employer is putting in money into your super. So very important to understand that. And what you need to note is being all over this, like I said, every year, because the caps are forever changing. Previously it was $25,000. So it's forever going up and down. Okay. Now, this little sneaky other consideration, and whether it's happening a lot or not, you need to just understand and make sure when you are salary sacrificing, when you're putting money into your super, that your employer is still doing their bit. They are putting your SG into your super. There has been cases in the past where employers have done a bit of a cheeky one and they've stopped doing the contributions. So they thought, well, this individual is putting $15,000 inside super, and we're going to stop our SG requirements. There's already funds going into super. So be all over that side of it as well. Just make sure when you are salary sacrificing, now I'm not saying employers are doing this, but I've seen it firsthand. But just make sure when you're doing this, the salary sacrificing, and look back on your super statements and just make sure that your employer is also putting their bit, which is at the moment is 10% of your salary on top needs to go towards your super. Let's have a look at a case study now, side by side, of what it looks like for an individual to not salary sacrifice versus salary sacrifice. Let's have a look at comparing an individual who earns $65,000 gross salary. And in situation A, there is no additional contributions. So no additional contributions in terms of no salary sacrificing. And in situation B, there is salary sacrificing. And the amount that they're going to salary sacrifice, we are going to get into as well. So the first comparison, gross salary, $65,000. I'll just put a line through this section, make it a bit more clear what I'm trying to do here. The next line is what is actually being less salary sacrifice. What is actually being put into super in terms of extra contributions. So individual A, what do we say? 0. They're not doing anything. Just going as business as usual. And the second individual, they're going to salary sacrifice $3,172. Okay, going a bit further down, we have then the taxable income. So this is outside of super. So what we've got to consider here is we're comparing outside super world versus inside super world. So this portion here is looking at the taxation outside of super. What's my assessable income? And what did I say at the start? I said as you salary sacrifice, those funds are not being paid to your bank account. Therefore, when your accountant outside of super is going to sit there and go, well, what was your assessable income for the year? For this individual, in case A, it's still $65,000. But in case B, what we got is 65,000 less this amount, which becomes 61,828. Therefore, their assessable income is lower. Now, what does that mean for their tax position outside of super? We're going to get into that as well. So less income tax. And for individual A, they have to pay around 12,867. And in scenario B, tax drops to 11,725 because of the salary sacrifice, again outside of super. So what is the net salary here? We have $52,000, no change here. So $52,000, basically 65 minus 12,867. And for scenario B, we have a net salary of $50,000, 103. So yes, net salary drops because less money is hitting your bank account. These funds that we spoke about in terms of salary sacrifice are being paid to super. So yes, there are cons in the fact that you're going to have less funds sitting in your bank account, but you got to look at the overall picture in terms of growing your super, lowering that tax bill outside of super as well. So what does it look like in terms of net super position? And we are going to get into the total position. So scenario A, zero difference because they haven't salary sacrificed. In terms of the individual, in scenario B, it becomes a total net super contribution of 2,696. And why is this lower than the the salary sacrifice? Is because there is a 15% tax on contributions, concessional contributions, so that is lower to 2,696. The first 15% is paid to the ATO. So, end position, which is what everyone is interested in. What are the overall benefits of all this? Why do I need to sit there talking to my employer, and why is everyone doing this around me, my family and friends? So an end position of salary plus super. What does that all look like as we keep going down and down? So for this individual, no difference there. It's basically the after-tax net salary. But for this individual, when you combine what's gone into their super plus this amount, the total is 52,799. And when you compare these two figures, what's the overall difference? And that is $666 net difference in your total circumstances benefiting super and salary, considering of a benefit of $666. If this video was of value to you, make sure to click the subscribe button and the bell button, as we are releasing videos every other day, and you can be all over it regarding superannuation and investing matters. Now, if you are looking at getting some superannuation advice, there is a link also at the bottom where you can lock in a free 30-minute video strategy session with a financial advisor at Anchor Wealth. What we will do, we'll go through your circumstances regarding super, do some projections, identify whether there is a gap, and then what your options are going forward from there.